Welcome back to the channel, everyone. Today we're diving into one of the most misunderstood, most emotionally debated, and most strategically important developments surrounding plug power. What looks on the surface like a boring, sideways moving stock hovering around the $2.20 level is in reality a structurally loaded setup, one that is mathematically unsustainable and fundamentally mispriced based on the expectations that the market has built around this company. Most retail traders look at Plug Power and see a broken stock, a company that has diluted shareholders into oblivion, burned cash like a furnace, and consistently disappointed on execution. If you go to message boards, Reddit threads, or Twitter commentary, the consensus view is always the same. Plug Power is dead money. Hydrogen is a fading dream. Bankruptcy is inevitable. The stock is destined to drift lower as the hype cycle of 2021 becomes nothing more than a historical footnote. But the reality today is far more complex and potentially far more explosive than those simple narratives suggest. What we are watching at the $2.20 level isn't a random support zone. It is not a psychological bottom. It is not a coincidence. This level is a battleground, and it is defined by two forces. One, the massive November 2025 capital raise that reset Plug's liquidity clock, giving the company a meaningful runway into 2026. Two, a massive pile of short interest, over 305 million shares, that has refused to unwind, even after the stock climbed significantly off its 52-week low of 69. This combination creates a mathematical tension that cannot continue forever. One side of the trade is going to break. The only question is which one. Let's sit at 4. Let's start with the short-term technical picture. The stock closed at $2.20 with an intraday range of $2.18 to $2.32. That kind of price action, tight, compressed, indecisive, would normally suggest neutrality. But when you zoom in, you see something different. The chart is moving in a barbed wire pattern. Every time bulls try to push the stock above 2.30 cents, selling pressure hits instantly. Every time bears try to push it below 2.18, hidden bid walls appear. This isn't normal retail action. This is the footprint of algorithms. Friday's 1.35% decline was not a sell-off. It was a containment move, a deliberate compression to keep the stock in a controlled zone. Why? Because the financing announced in late November, specifically the $375 million convertible senior note offering and the $399 million net cash total, did something the bears didn't expect. It killed the liquidity crisis thesis. For months, the dominant bearish argument was simple. Plug will run out of cash by Q1 2026. Bankruptcy is coming. That argument evaporated overnight. Plug Power now has enough liquidity to survive into late 2026, possibly beyond, depending on operational efficiency. With the financing done, the bears must now pivot to a very different argument. It's overvalued long-term. But long-term valuation concerns do not justify a 305 million share short position at these price levels. As of mid-November 2025, 305 million shares are sold short. That represents 23 to 25% of the total public float. Days to cover has risen to 3.06. In high-frequency trading land, anything above 3 is a siren alarm. It means if even one positive catalyst hits, DOE loan finalization, new customer contracts, Fed rate cuts, data center deals, the exit door for shorts is too small. They cannot all cover at the same time. They physically cannot. And when forced covering begins, price discovery becomes violent. In mid-November, there were 2.4 million shares failing to deliver at the 249 price level. This is often a sign of naked shorting, administrative strain in share lending, market makers unable to locate sufficient shares, synthetic liquidity being used to suppress volatility. This artificially increases supply in the short term, but in the long term, FTDs must resolve through forced buying. Retail traders often panic at price suppression, but price suppression doesn't mean weakness. Price suppression means future buying is guaranteed. Now let's zoom out. We are operating in a fundamentally different macro climate than the hype cycle of 2021. The green energy sector has matured. The days of wild speculation are gone. The market now demands math, execution, and measurable economics. The Inflation Reduction Act's 45V hydrogen tax credit, worth up to $3 per kilogram, was finalized back in January 2025. At first, the market hated the stricter rules around time matching, additionality, emissions traceability, but Plug has spent the past 11 months rebuilding its business model to comply. The Georgia and Texas plants are the first test cases. Right now, the 2 to 20 cent stock price does not reflect the possibility of Plug fully qualifying for the $3 credit. If they announce compliance in the upcoming Q4 earnings call, the repricing could be immediate and dramatic. Institutional data is telling a story that most retail traders have missed. Traditional long-only funds DI'd trim positions. That is true, but they were replaced by quant funds, index tracking instruments, statistical arbitrage algorithms. Why? Because Plug has stabilized above $2. Below $2, funds are forced to liquidate due to compliance rules. Above $2, it stays in indices and remains tradable for structured products. This means, and the fact that Plug raised nearly $400 million without breaking below $2 is a massive sign of institutional confidence. Think about it. If Plug were truly going bankrupt, Wall Street would not give it hundreds of millions in fresh capital. Let's shift from the stock mechanics to the business fundamentals. Plug Power is no longer just a forklift fuel cell company. The real story for 2026 and beyond is the demand for hydrogen electrolyzers is rising globally due to industrial decarbonization, steel and ammonia production, government mandates. Plug's electrolyzer business is still early, but it is expanding faster than their legacy segments. This is the sleeper catalyst the shorts are ignoring. The world is entering a power capacity crisis. AI data centers, cloud computing, grid instability. Plug is positioning hydrogen fuel cells as backup and prime power solutions for hyperscale data centers. If Plug announces a finalized deal with Amazon, Microsoft, Google, or Oracle for large-scale hydrogen backup, the short thesis evaporates overnight. The bears say hydrogen is too expensive. The bulls say grid reliability is priceless. At $2.20, the stock is basically an option on the future of energy reliability. We need to be responsible and discuss the real risks. The November convertible note offering will result in dilution if conversion levels are hit. Dilution is the biggest enemy of long-term holders. Plug has a history of burning cash aggressively. Until they hit positive cash flow, projected for late 2026, they remain dependent on external funding. If the global economy enters recession in 2026, capital dries up and Plug